What's up, builders? This is Raise the Bar Radio, where we talk about building wealth, raising capital, and all in all, raising the bar in your business and your life. This is the No BS podcast for capital raisers, investors, and entrepreneurs who are serious about scaling their business and living life on their own terms. I'm Seth Bradley, securities attorney, real estate investor, and entrepreneur, bringing you world-class strategies from the best in the game. If you're ready to raise more capital, close bigger deals, build a better you, and create true financial freedom, you're in the right place. Let's go. What's going on, y'all? Welcome to Raise the Bar, elevated conversations around entrepreneurship, capital raising, and real estate. Today, we have a longtime friend of mine, Sandhya Seshadri. We've known each other for a number of years. She's a prolific multifamily investor, invested in over 3,000 doors, $200 million in assets, and is a featured speaker across national stages and shows. Sandhya, how are you? It's so good to see you. Welcome to the show.
Doing great. It's really nice to reconnect with you. It's been a while. I think I've known you for 6 years now in the business.
It's been a while, right? Did we meet at like the Adam Adams meetup,
Yep.
I think, once upon a time in Denver?
Yes, we did.
Yeah, that's awesome. That's awesome. And he's since moved on to a few different things. I've noticed he's a salesman because he can move. He can just change to like fitness and
anything.
podcasts and anything, and he tends to make it work. Mm-hmm. Where are you tuning in from?
What?
Where are you tuning in from?
Oh, I'm in Dallas, Texas. This is where I've lived for over 35 years, so it's like home.
Awesome. So we can jump right in. I mean, Dallas is like the multifamily capital of the world. Are you still buying multifamily, or what are you into nowadays?
So I underwrote a lot of multifamily deals, especially the ones that were on sale right next to my existing properties, but they still didn't underwrite for very high cash flow, which is what my investors are looking for. So I have actually switched since 2023 when the interest rates were too high and multifamily deals kind of went away. I switched to oil and gas investing, and I tried it out myself passively, and so now I am on the active side for those investments.
Very cool. So tell us a little bit more about that. So you switched mainly because cash flow, you saw that is a more attractive asset type to get your investors cash flow?
Yeah, we found that oil prices were pretty good then, and if you can underwrite to whatever is break even, right? Just like in multifamily, we underwrite to a certain break even occupancy. Similarly with crude oil production, you know what your break even cost is, and so you model your returns based on the crude oil prices. And I found it to cash flow really well. So an investment I made passively in 2023 has returned more than 80% of my original capital back now, and we're not even at the 24 months just yet. And so again, of course, it's affected by crude oil prices. But one of the biggest risks that you take on when you do oil investments is the risk of a dry well. So we instead go into places where oil has already been found. If you imagine like a rectangular map and you get the mineral rights to do drilling in that one little spot where you've already found oil around it, and then we invest once oil has been drilled in at least one well. And we invest in 4 to 6 wells typically, so that the average production of all those wells is like, you have some that were low, medium, high kind of. But yeah, that's been cash flowing much better for my investors. And also in terms of tax benefits, you can structure the deals to be, meeting their tax requirements that they were looking for in real estate. But now you can do it in oil.
So, can you break that down a little bit more for me, like the different types of oil and gas investments? I know, you mentioned a dry well is one of the biggest risks, right? I know there's some that, some funds or some companies that focus on exploration, and it's really a crapshoot whether they're going to hit oil or not. I mean, obviously they do their research and they try to hit oil, but it's kind of like a lottery ticket. But some of these other ones where there's already active wells, or you're drilling near an active well, you increase your chances, or obviously if it's active, you're already going to get that. But could you kind of explain kind of the different types of oil and gas investments and kind of the risk profile associated with them?
So it's just like even when you compare to multifamily or retail, you've got your little mom and pop stores, and then you've got your Walmarts and Targets, right? So we, in terms of oil, would rather not go with a mom and pop store because all of the capital raising that they do is to fund this first cycle of drilling. And let's say they drill somewhere and they don't find the oil, then you're kind of like, okay, I need more money now kind of scenario. Versus if you go with the Walmarts and Targets, which in this case is Chevron, Exxon, kind of the humongous companies that have spent hundreds of thousands of dollars in the research that goes into identifying the locations where you can find the oil. And then you find this, let's say, as I described, a rectangular plot where oil has already been found and they're already having active wells and drilling is going on, but you get the mineral rights to a piece of it, just like you're bidding on a piece of land or a piece of a property. Then your probability is increased, and then they drill and they find oil. We usually get in right when they've at least drilled one well and found the oil there, and then we have the rights for maybe 4 to 6 wells or so. And that's how we do ours. So again, the difference in the large companies when they do their drilling is there's horizontal drilling and there's vertical drilling. So in the past, we used to only just straight drill down, but now you've got also horizontal drilling going on. And these companies are already established in drilling already in that area. So adding on our little piece is not going to be such a big effort on their part. And so they also have, therefore, their production down pat to where the drilling costs are low. So let's say their break-even cost is $30 or $35. Then that's where you look at crude oil price and say, okay, how long is it going to stay below $30, right? It could dip, like it dipped to $0 at COVID, but then it went back up later. So you got to be in a holding pattern like we are now with interest rates and real estate. Sometimes that might happen, but what are the odds that it's going to stay below that break-even point for a long time, right? So that's the risk you have to kind of think about as an investor or as a fund manager raising for such a deal is, crude oil price will affect the results of your deal. So you model it for different prices, just like you model multifamily for different cap rates.
Right, of course. Yeah, is it like Landman where you need to find that happy medium like in oil prices, or you just want it to go to the moon?
Well, today it's in the range of $60 or so. So you say, okay, if oil prices stay at 60, what is my return versus it goes up or it goes down, and accordingly, am I willing to live with that? We also don't actually sell the deals. We just hold them forever because the peak production for an oil well is somewhere between 18 months to about 6 or 7 years. So after that 7 years, there's really not much life left. So it's not like a building that's still existing you can resell. So you get all of your money out, most of your money out in that time window. So typically, again, based on crude oil prices, you get anywhere in the range of 2 to 3x your money. And after that, it just goes down to a trickle. Sometimes 15 years later, you might get $50 as a distribution. But you get most of your original capital back in the first 3 years. And then, like with every deal, how you structure it is going to determine the tax benefits. So some people want tax benefits, and accordingly, we structure the deal, and they do have to come on briefly as a general partner for that first year. So let's say I have a deal in fall 2025 and somebody signs up for it. We make them a general partner for 2025, so they get that 80% depreciation. So roughly 1/3 of that is about close to $27K. So you get on a $100K investment, you save $27K in taxes for that year one, but you do sign on as a GP and take on the risk. Now, a lot of other dealers in these oil production, they offer a deal where you haven't even started the drilling. So your upside is greater because you're taking on a bigger risk. It's almost like in the stock market, small cap versus large cap, right? There's a risk reward ratio within that. And some people just structure the deals for legacy wealth building as they establish a fund and keep acquiring more and more wells. Ours is like each deal is like specific building in real estate. Here these are your 6 wells. Here is the deed. So a month after acquisition. Another thing people ask me about is, what about Ponzi schemes? How do I know my money is actually going into whatever you're telling me it's going into? So that's where we say that once your deal is done in your next monthly report, we typically graphically show you, hey, these are the exact 6 wells that were purchased. Here's the county records, whether it's in Texas or Wyoming, wherever the wells are located. That's how you verify the production. So we reduce the risk of, the dry well risk. And we also avoid the Ponzi scheme risk by showing you exactly where the well is, and here is an actual deed of the purchase. But the other risk you're taking on with oil is always going to be that crude oil price. And then for the tax benefits, I've found this to be far better than multifamily because, one, you can offset any income with this. So let's say you're a full-time practicing lawyer and you got nothing to do with real estate or drilling. You can still become a general partner in this drilling for that first year and take the depreciation. And there is no recapture afterwards. So when we sell a building in 5 years, my apartment complexes, even if the deal loses money, you already took all your depreciation beforehand. Every year you're telling the IRS, oh, I put 100K, but I have a minus 100K loss in this in year 1. And then year 2 is another 10K loss and 20K loss. Well, by the time you get to year 5 and the deal sells, okay, you've basically been so negative that now you owe some taxes back in recapture. Well,
Right.
with this, you don't have it because it's in oil. The tax benefit comes from tangible and intangible drilling costs and depletion allowance. That's all in the tax code. So the easiest way, again, is check with your CPA. So if someone's interested in an oil deal, we'll show them a past K1. Like I've done this now for 2 tax years. I've gotten the K1s and been able to apply them. So again, we can show you, K1 examples. You take it to your CPA and say, hey, can I actually apply this? And that way you know for sure. So always, check with your financial planner for your, see if oil even fits in with your risk tolerance, and then the CPA for the tax benefits piece of it. But I'm finding more and more general partners, fund managers shift to asset classes like other businesses, retail strip centers, mobile home parks, buying what they call boring businesses, triple net leases, etc., and oil and gas instead of just sticking with multifamily because it kind of crashed and burned with the interest rates going up. Hopefully it's on the mend and it's coming back.
Yeah, at some point it will come back, but it's very competitive right now, right? And it seems like when it's that competitive and the interest rates are still high, the cap rates are high or low. It's just it's crazy out there. So people are turning to oil and gas. We're seeing a lot of debt funds, lots of people rolling up businesses, like you said, paving companies, roofing companies, service companies, things like that. You're seeing a lot of creative stuff out there. You mentioned something about the LPs actually coming on as GPs for a year so that they could capture those tax benefits. Is there any risk associated with that? Because us as GPs, when we're raising capital and we're on the GP side, that's kind of one of the things that we talk about is we're taking on the risk, right? Like we're the ones that are going to be liable for making decisions, things like that. How would that work with the LPs that are kind of temporarily coming on there as a GP?
So anything that goes wrong that year, yes, they could be liable for it. But here's the protection, first you have the big companies. So if an accident happens or something, your large companies already have the insurance to take care of it. And then we do as well for the LLC that is buying these, right? The acquiring LLC usually has insurance protection, just like in a rental property. I've got my LLC buying it that has the insurance coverage. But yes, beyond that, yes, you are still liable for the year that you are an active general partner. Versus people on the GP side like me, we're liable forever. Versus these people who come on board. And that's why these fall offerings are very popular, because it's a very short time. By the time my next deal closes, it'll probably be November. So then, you got December left, and then that's it. The next year you get converted back to LP. But yes, you are taking on that risk. And we make sure the partners who want that tax benefit understand what they're taking on.
Right. And we all know that deals usually go pretty well at the beginning, or, that first year, you're not really going to have any issues. If issues come up, it's usually going to be down the line somewhere towards the end of the deal, or, once it's kind of got rolling. So that first year or even partial year, the chances of something going wrong are not great. Do you disagree?
I'm just going to say anything could happen, right?
Of course.
Especially when I'm speaking to a lawyer. I'm not going to say there is no risk, obviously.
Right. I'm not saying there's no risk either. I would never say that.
Risk.
But
you are taking
yes,
on a risk.
Course.
So do you want that or not? Because
Sure.
the other side of it is my cash flow so far has been double digit. Like I told you, if I put 100K in 2023, and by now I've already gotten 80K back, and that's not even including my tax benefit. I mean, that's like getting all my money back in such a short time. And so even if that takes 3 years to get it back, that's double digit cash on cash every year. Who's giving you double digit cash on the LP side every year, right? So that's the reason I even expanded to this sector is my LPs were tired of having barely any cash flow, 2%, 3%, or barely any, completely stopped distributions because of bridge loans, And that's why I had to find something which had better cash flow and then test it out myself by investing in multiple deals and cycles and seeing how that worked and then starting to share that. And I'm seeing so many other fund manager friends that you and I know that are hopping into this energy sector as well as just another way to diversify. So when real estate goes down, maybe oil's doing well, etc. So you're having non-correlated assets in your diverse portfolio. And the percentage allocation, of course, depends on your risk tolerance, investment goals, how soon you want your money back, the cash flow, etc.
For sure. Tell us a little bit more about the due diligence you would do on a sponsor. So whether it's a fund manager or whether it's the actual operator, tell us, is there anything specific in oil and gas that you would do differently than you did when you did your due diligence on lead sponsors in a multifamily deal? Pardon the interruption, but we don't do ads. Instead, know that if you're raising capital for real estate, my law firm, Raise Law, is here to give you the expert legal guidance you need to raise capital compliantly and structure and close your deal. And if you're looking for a done-for-you fund-to-fund solution, TribeVest is the industry's only all-in-one setup and fund administration solution. Visit raise.law and tribevest.com to learn more.
I would still want their track record. I would still want to do a background check. So that's always the same. In terms of history of past deals, when I get close to investing large sums of money, I always like to get a reference from a passive investor. So that's also the same, except it's oil versus real estate. I wanted to know, hey, I hear so much about Ponzi schemes. How do you verify that the money I wire you is actually going to purchase what you say you're purchasing? Because, with a property, I pull up the address in the county records. I know how to check that with real estate. So same thing with oil wells. Okay, you're going to show me the county records. You're going to show me the exact 6 wells you purchased or 4 wells or whatever. So that's another thing you want to know. And you want to know, what are their operating expenses so that their break even, you understand the deal numbers itself and at what point. And the other aspect with oil that's very different from multifamily is multifamily, I like people who are more hands-on, close to their properties and things like that. With oil, I really like the large operators just for their scale, because they're not going to go broke if one oil, well doesn't produce enough oil. Or if crude oil prices crash for 3-4 months, they're not going to go broke. So that's an important piece is I discovered from learning. So always go with large operators. Check for any SEC or other bankruptcy and deals lost and litigations, etc., against any company you choose to do business with. And obviously, I can't mention names, but there are so many out there with open lawsuits, etc., from in the past. Also, why did they lose money? If they lost money in the past, if they've done enough deals at some point or the other, you're going to have a lemon, right? So why did they lose that money? What are they doing differently? And how are we going to make sure the deal I plan to invest in is not going to have that problem? And how much is their knowledge in oil and gas? How long have they been around? I'm only 3 years into oil and gas, but the people I worked with were born and raised in Midland, Texas, and breathe oil, right? It's in their blood. It's what they know really well. So they know the locations. So you want to know if more oil has been found around this area where they're drilling, so the probability of success is very high, right? Just like we choose Dallas as a market for multifamily because there's so much job growth and diversity of jobs and population growth and median income and all that. So same way here, you want to know whether oil has already been found in that area and how many times have drilling happened very close to where your wells are happening, and ideally you want them to have already started drilling and shown oil.
That makes a lot of sense. Thank you for that. And I just want to point out that these things that she just pointed out they don't just apply to passive investors. If you're out there and you're listening and it's for passive investors, it's also for you out there that are looking to raise capital for one of these big operators to put a fund together. You also need to do your due diligence on them, because you're going to put your passive investors at risk if you don't do your due diligence on them and make sure that you're checking up on all these things that Sandhya just mentioned.
Yeah, and some investors look for tax benefits, some don't want it. You want to explain that to them. Hey, regardless, this is the cash flow you get. Whether you want the tax benefit or not, you can take that first year election to be a GP or not. So again, this is especially helpful for fund managers as they look for other options that provide the cash flow that investors are looking for.
100%. What are you seeing out there as far as raising capital? I've seen a lot of folks, I work at TribeVest, so we see a lot of capital raisers come to our door. Lots are successful, lots are not. What are you seeing out there while you're raising capital as a successful capital raiser that's really working in this market where investors might be a little bit scared or standing on the sideline, kind of afraid of Ponzi schemes or an economy that's fluctuating or a world war, like all these things that are just kind of in the back of their mind? What are you seeing that's working right now?
So what's worked really well for me is, again, my past investors who trust that I've done my due diligence and I'm very transparent about my investment in each deal. And when a deal didn't distribute, they had an understanding of why it didn't distribute. So many of them followed me. There are a few, of course, who said, I will never do multifamily again, because they got burned from investing in other deals which have completely foreclosed, right? So those people are never going to come back. So there's going to be a certain percentage you will lose from your past. But as far as raising capacity, right, at the peak of the market cycle, $5 million I could raise for a deal, no problem. And now I'm switching gears to another sector. So it's like you're starting over from scratch. So you keep the education, just like we were educating on multifamily or other aspects of real estate. Now you got to start the same thing with oil and gas. For me, LinkedIn is one of my biggest platforms where I get a lot of DMs, and that's where I raise capital, and then referrals from my past investors who say like, hey, if I had more money now, I would put more into your deal, but I'm going to refer you, this guy needs a tax break, this guy needs a investment that's going to give him some steady cash flow, etc. So I get a lot of referrals. That still works. So for every person who says, no, I'm not going to invest, etc., say, is there somebody else who might be able to benefit from the deal that I have to offer and these kind of offerings, and keep educating. So I say, tell me the biggest risks and fears you have about this investment. And the number one when you come to oil and gas is dry well, Ponzi schemes, and then crude oil prices. So you go up front and address all the elephants in the room, if you will. It's the same with multifamily. Hey, I know multifamily did poorly. The deal I got in 2022 didn't do so well, but I've got this great deal now because prices are a bargain. All those deals are crumbling, so now they're being sold for a much better price, etc. So whatever is your case, right? Is it good enough for you to invest in? If you just reverse the table, right? And imagine you are getting pitched a deal. What does it take to convince you? And role play that and say, okay, what is the data behind the confidence in this deal? And what are the risks? Be open about the risks, because you don't want that investor putting $50K into your deal and calling you every week versus the $500K check writer leaves you alone. It's like, I know that's how the market is. I know crude oil prices fluctuate or interest rates fluctuate. I know you're doing your best. You want those investors. So, you might have to find a different room for those investors who have the sophistication to understand the risks and don't bug you all the time.
I love that. You sound like you might have coached some people on capital raising before.
Well, people ask me all the time, how do you find your leads? And it's like, well, leads find me because they see how open I am about the problems as well as the success. So it's not like passive income lifestyle, I found this unicorn deal that nobody else found. Somehow the broker decided to award it to me, little me, right? So then when you don't say bizarre stories like that, you just be open about them. Yeah, I bid on this deal, I found this, and this is why I think it's great, and I'm putting money into it, so I'm taking on the risk.
Yeah. What's a common mistake you see out there that people are making when they're raising capital?
A lot of them don't understand the risks, or they try to hide it. And then when it comes to, and a lot of these real estate deals especially, they cannot explain the underwriting. So if you can't explain the underwriting and you can't explain the assumptions behind it, like I asked them, what is the exit cap rate and its effect on your returns? They don't understand it to explain it. Or how do you justify this kind of other income from parking when there is no substantiated evidence that, a poor, day laborer making $50K a year is going to pay you $50 extra for that parking? They don't understand it in depth enough to explain it. And so oftentimes they'll need some lead sponsor to come alongside with them, and then people are like, I might as well go with a lead sponsor who can answer my questions, and they start directly going to them. So I see that problem is people are not investing enough time in the education and knowledge piece, and they just want something quick. They want the results of somebody who's worked for 5-6 years on this overnight for themselves.
Yeah, I love that. I mean, you see tons of people kind of getting into the capital raising space, and they're not putting in the effort, right? Like, you've got to put in the effort. It's got to be top of mind. It's got to be what you breathe, right? Like, it's got to be just your primary function is raising capital. Like, if you want to take on that responsibility of raising capital from passive investors, then you need to understand the gravity and the weight of what that is, and it's using other people's money, and you need to value that higher than even your own. And what that means is you've got to know your deal. At a baseline, you've got to know your deal, you've got to know your numbers, you've got to know what your investors are actually going to be investing in, and hopefully you're also investing in it yourself, or you wouldn't be promoting that deal to your investors.
Yeah, what inspires confidence in an investor to trust you over the other 500 people who are emailing them and blasting them with messages, right? You might be the best in automation, but if your email has the name of some, I don't know, unicorn investing, and I have no idea who's the person behind it. I get so many emails with all these fancy names of companies and logos. I have no idea who the human is in there. So like, put a video, put your face there, and follow up the email with an actual personal call. If you need, you might think you need 500 people in your, list. You actually need about 10 people writing fat checks, and you're pretty much done with most raises. And so invest in depth in those relationships. And if they say no today, doesn't mean it's no in 3 months. You want to find out when they're looking to invest, what types of deals meet their risk tolerance and their asset allocation, right? Those two. And then accordingly, you can steer them to, hey, I don't have a deal, but I think this other deal might be a good fit. You want me to make an intro, Like, just be, abundance mindset is how I'd call it. So I've referred people to others when I didn't have a deal. Like, people wanted only multifamily. I was like, I'm sorry, I can't see a deal that makes sense for me. I'm going to refer you to these other guys who seem to be doing a lot of deals. But I'm on pause for multifamily now, kind of thing.
Gotcha. Yeah, I love that. Let's switch gears just a little bit. And I'll start out with an example. So once upon a time, I went to medical school for about 1.5 years, and then I dropped out because I absolutely hated it. And then I ended up getting my MBA and going to law school, and here I am, right? Totally different pathway. So in a parallel universe, tell me about a different version of you.
I was doing technical work at Texas Instruments as an electrical engineer. That's my degree. So I have a bachelor's and master's in electricals. I was doing failure analysis, and I was doing test engineering, product engineering, and large program management. So like the Bluetooth and the GPS chips, as an example, that go into your phones, integrating those, putting those into one little, microchip and making it tinier and tinier, so we get the big business. With the Apples back in the day, it was like BlackBerry or Nokia or whatever, right? So now it's Apple and Samsung and so on. So who are you going after? Like that electrical engineer mindset, that technical analysis, the comfort with numbers, and project management, right? I'm talking to designers located in Israel and India, and an integration team in the US, and manufacturing in Taiwan, right? So all of those skills I find very, very handy in real estate and asset management. And I went to evening and weekend school because my company paid for it to get my MBA. And because of that, I traded stocks for the longest time. So even when I had kids, I took some time off from corporate. I would just trade stocks for a couple of hours a day. And that was financially enough for me to just say, okay, I don't even need to have a job kind of level. But, stock trading is very fun for me. That's why I say it's not all or nothing with one asset class. Definitely keep your liquidity with your 6 months of savings, liquidity with stocks, and then balance it with assets that make sense for your needs, right? Like what is your time horizon as well as risk tolerance.
That's fantastic. I always talk about, leveraging your skills that you learn from school or your W-2 as you and as other folks kind of venture into the entrepreneurial world, whatever that might be, building a business or buying real estate or raising capital for oil and gas, whatever it might be. There's something there that made you successful in your W-2 that you can leverage to be successful in your next ventures as well.
Yep.
What are some of the major influences that kind of brought you into this world that you're in now with capital raising and real estate and oil and gas? Early on, what were some of those major influences that kind of really turned the light bulb on for you and kind of really changed your pathway?
So I was trading stocks and taking care of young kids and getting pretty intellectually bored because I'm used to interacting with a lot of grown-ups, and this stay-at-home mom lifestyle was like, okay, it's kind of okay, but I need to go meet people, I need to go have a life, and I need something to reduce my taxes because my husband had a W-2. He was paying for the, roof over our heads and having our benefits, and then I was trading stocks. So we never had a business or any other way to diffuse, offset our taxes. And I wasn't a handy person to do my own fix and flip or single family rental and, go fix a leaky toilet on Thanksgiving Day. So I attended a weekend event, many that were happening in the Dallas area. And then I joined a mentorship to be able to underwrite and go after multifamily. This happened back in 2018 when we were still in the peak of the market cycle. So things went very well. So I have several full cycles that went well, both on the passive and the active side, until about 2022. And then multifamily kind of slowed down. And that's why I pivoted from 23 to oil and gas. But taxes were the first thing that drew me. And then I always wanted to have something to do with real estate, just didn't want to do all the hassles of a handy person and didn't have the fix and flip background. So when you do things at scale, it was very similar to project management. Underwriting was easy to understand in a spreadsheet. I mean, it's all about the inputs. Garbage in is garbage out. So what assumptions are you making? That's what's going to give you the right, or the realistic, returns on projections on a deal.
Totally. Yeah. Are there any limiting beliefs you had to overcome to kind of make that jump from the W-2 to entrepreneurship?
Yeah. I mean, I was afraid. I was like, what if everything, crashed and burned? How the heck can I go buy this humongous 100-door building that I drive by every day? It's like, that's owned by billionaires, people like Trump or something, That's not for ordinary, everyday people like me. We go buy single family, maybe. So this whole concept of leverage and syndication. So it's like, the bank is, going to loan you 70% of the money. You need to buy something large. The remaining money, okay, you've got to market and sell and tell people why and how this is a good investment. And I was very scared to take other people's money. So my first deal, I partnered with people with experience, but as boots on the ground, I was like checking and driving there almost every day and checking on the property, especially the first few weeks. And then once it actually happened, like what you put in the underwriting actually came true in that golden era of multifamily, that started building confidence. And that's when I was like, this could actually come true. This has come true. We've actually made money on these deals. This is pretty great. And so I continued until it stopped producing when the interest rates went up.
There you
and
go.
I was like, I got to shift. I got to do something else.
Yep. Smart people like yourself, you gotta pivot. You gotta change a little bit and go where things work, right? And if multifamily isn't working right now, figure out what's working, what's best for yourself and your investors. Give me a core value that you've kind of hung on to through this whole thing. I mean, is there any like specific core value or two that just kind of runs your life or you're always kind of thinking about when you're making a decision? Anything like that come to mind?
I mean, it's fundamental. It's do unto others as you would have done to you. So don't go try to pitch a deal to somebody that you wouldn't pitch to your best friend, your mom, your aunt, a debt fund, rescue fund, whatever it might be, right? Like a lot of people claim to be true people of, faith and whatever else. It's like, dude, would you put money into this deal? Would you ask your mom and dad and friend and best friend from college and all of them to invest in this deal? Then why are you pitching it just to a select few strangers? That's a core value to me. If the deal isn't good enough for me to put a good chunk of my money into it, there's no way I'm taking it on and taking other people's money into it. That's a core value for me.
For sure. Let's start wrapping it up. But how are you raising the bar in your life and in your business right now?
So the first thing I invested in, health was a big challenge for me. So I invested in a standing desk, and I have a desk treadmill. So I do a lot of my meetings that way. I start the day with sunshine, and then I just make little switches. Like football season is here. I love it. But instead of doing wings and beer and sports bars, I planned my meal ahead of time, and I said, let's try not to have any alcohol unless we absolutely feel necessary. And I've watched several games already now without any alcohol, and I didn't miss it. So I'm not saying I'm alcohol free forever, but it's not part of my culture now to have football, wings, and beer go all together at the same time. So that's an easy health switch. And because the more healthy you get, all other aspects of your life also get better. The other one is I am addicted to my phone. I have been for a long time. So whenever my kids are with me, and I have a teen and I have a grown-up kid, and of course my spouse, I just give my phone to my kids, and I say, if anything really important buzzes, you can let me know. Otherwise, I want to be fully present when I'm talking to you. So that's an easy way for me to avoid the phone distraction. And then setting limits. Like I used to be up on weekends, evenings, etc., talking to investors, and I had to put a limit to that and say, sorry, it's off business hours. I'll get back with you the next business day. And
those are
traveling more, because right now we are facing the recent death of a celebrity, Charlie Kirk. Life is too short. Don't postpone joy. Don't say, oh, when I have $1 million more, that's when I can afford something. Well, let's see what we can do. Maybe a smaller version of that to go like on trips. So travel is my favorite. So I hack travel a lot. And I find ways to travel for free or cheap so that I can go travel the world, because who knows, I may be disabled by the time I'm 75 to go do all those travels. Why wait?
100%. I'm right there with you. If I get an opportunity to travel, If I get an opportunity to travel, I'm gonna travel. If I have to work a little bit in the morning to make it work, we'll work while we're out there. But I'm always a yes man for travel, going out there, seeing the world, seeing what's going on. You can't put those things off.
Yep. Don't postpone joy.
Sandhya, where can our listeners find out more about you?
You can find me on LinkedIn. Easy to find me. They can find me through you. But my website is engineer-capital.com. That's my website. Right. You can reach out to me there, download my checklist, etc., etc.
Awesome. Thanks so much for coming on the show. Great catching up with you.
Thank you. I appreciate the opportunity.
Thanks for tuning in to Raise the Bar Radio. If you enjoyed today's episode, make sure to subscribe, leave a review, and share it with someone who needs to hear it. Keep pushing, keep building, and keep raising the bar. Until next time, enjoy the journey.